Good afternoon. Welcome to Venable and welcome to our program today entitled Cross-Border Money Transfers, Key Requirements Every U.S.-Based Nonprofit Needs to Know. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice here at the Venable Law Firm. Happy New Year to all of you here in the room and to the 200 or so folks who have joined us on the webinar across the country today. We're starting off our new year with early this month with our monthly nonprofit legal program. Will be going on 4 years in April of these programs. We're pleased that so many of you come back and participate and join us in person for lunch if you're here in the D.C. area or on the webinar for these programs, and we look forward to an exciting array of topics that we'll be covering during the course of 2015. Before we get into the heart of today's program, a few housekeeping items. First, for those of you who work in the trade and professional association community and hold a certified association executive credential, these programs are eligible for CAE credit. We have one scheduled upcoming program so far. Next month, our program on February 18th is entitled 1 Year Later, Time for Nonprofits to Implement the Super Circular. For any of you who are federal award recipients of federal grants, contracts, or cooperative agreements, you must by now be very familiar with the Super Circular, and you're probably overwhelmed with it and its implementation and very confused by it. It's an area that we've been doing extensive work for the last year plus, working with many of our nonprofit clients. It's a very interesting but difficult and complicated area, but hopefully we're going to help simplify a lot of that for you next month. And so if you do receive any federal money or you plan to in the future, this is a program you're not going to want to miss. For those of you here in D.C., you have a handout booklet in front of you that has a copy of the PowerPoint slides from today's program, along with full bios of our speakers. And there are a number of articles, a half dozen or so articles on related topics that we've included there as well. Those of you on the webinar received a link to the PowerPoint slides, and tomorrow all of you will receive an email that contains a link to the recording of today's program, the streaming PowerPoint presentation with the audio recording, along with all of the handout materials. Feel free to share that with others, colleagues and others who may benefit from that. Also on the last slide of today's program are links to Venable's online library, a pretty vast library of legal resources, publications, alerts, PowerPoint presentations, and all of our recorded webinars going back for the last 4 years or so. So feel free to take a look at those, and most of those are searchable by topic area. We are going to take questions throughout the program today, so ask your questions as they come to mind. For those of you in the room, just raise your hands, and Marion will come around with the microphone. Please wait for the microphone so those of you on the webinar will be able to hear. And for those of you who are participating by webcast today, just pose your questions to me using the chat feature, and I'll pose those to our speakers at the appropriate times. We are pleased to have two of my colleagues here joining us for our program today. First, to my immediate right is Lindsay Meyer. I've had the privilege of working with Lindsay for the last 15 plus years that I've been at Venable, and Lindsay's been here for, I think, 25 plus years. Okay, a couple more. Lindsay is head of Venable's international trade practice, but in her spare time is also co-managing partner of our law firm. Lindsay's a terrific lawyer, a great colleague and partner, and very good at what she does. She works with many of our nonprofit clients every year. She and her colleagues in a wide array of international trade, import and export issues, and other related regulatory issues affecting nonprofits that are operating overseas. She really knows this area inside and out, but also really has a terrific and keen understanding of how these issues play out in the nonprofit context. You're really going to benefit from her insights here today. Her full bio is in the handout materials. And then Charles Kolstad was kind enough to fly out here from beautiful sunny Los Angeles to freezing, frigid, cold Washington, D.C. Last night to join us for today's program. Charles is a resident in our Los Angeles office. He focuses his practice on international tax, corporate, and partnership matters. He assists clients in tax and corporate planning relating to the acquisition, disposition, and restructuring of corporations and partnerships domestically and overseas. He also advises foreign individuals moving to the U.S. in a variety of matters. And he has extensive experience representing clients during audits by the Internal Revenue Service and the California Franchise Tax Board, as well as in front of IRS Appeals Office and collections. More than anything else, We rely on Charles heavily in our nonprofit practice for his international tax expertise. He's really our guru when it comes to kind of the tax and monetary aspects, the regulation of money moving to and from overseas. And so not surprisingly, Charles is a key member of today's panel, and you're really going to benefit from his wisdom here today. With that, I'm going to turn it over to Lindsay to get us started. Lindsay?
Thank you, Jeff. Can everyone hear me okay? I'm a little bit taller. Maybe I should take my heels off. I do feel a bit like I'm with family, since I have worked with a number of you all in the past, either directly or just via line. And since the holidays have just concluded, it's a little bit reminiscent. My husband is one of 5 children, and his mother is known as Christmas Carol. She lives in Arlington with her husband. And so one of the things, if you want to stay in the will, is you have to come back to, D.C. area over the holidays to visit with Christmas Carol and her husband. So they're smart enough to only have a 2-bedroom condo. One room is their office and one room is their bedroom. So as it turns out, the Meyer B&B tends to be very busy over the holidays. So at one point we had 20 under our roof. And as I remind my husband, I love to see them come, but I love to see them go. So I'm very pleased to be back at work and getting a bit of rest. So I'm delighted to talk about today's topic. It's one that's near and dear to my heart, dealing with cross-border issues. As Jeff noted, we've provided guidance in this area for a number of years, and it's always dynamic. It's one area that follows trade policy in many respects, and so that changes daily, if not hourly. And living here in Washington, you certainly get that sense. You have to be up on current events and political issues because, frankly, that's what these issues and regulatory restrictions reflect. So, if you will, Woody Allen once said there are 3 types of people in this world. There are those that make things happen, there are those that watch things happen, and then there are those who simply wondered what happened. You don't want to be in that 3rd category when it comes to these issues. So hopefully you'll learn a little bit today. We'll talk through some issues. We'd like to just have it as a dialogue, so if you have questions, sometimes I tend to fall into Washington speak, speaking in acronyms and whatnot. So if I do that and you're not understanding me, please either raise your hand or send a note via the web, and I'll try and define what I'm actually talking about. So today's agenda, we're going to talk about some general concerns of U.S.-based nonprofits when operating abroad, just a couple of little tips and traps that we've seen. We're going to just do a brief review of the U.S. sanctions and embargo programs. Again, if you read the newspaper or catch your news online, you see that's been very hot and heavy lately. And one that's been particularly troublesome for most U.S. organizations have been the Russian sanctions, the Ukraine-related sanctions. So I'm going to do a little bit of a deeper dive on that one, but I'm happy to discuss any of the other ones, like the warming relations apparently that we're having with Cuba, or the issues with North Korea, or any of the above. And then I'm going to turn the dais over to Charles, and he's going to talk about the taxation of foreign operations. So that's our agenda for today. Let's get started. Okay, some general concerns, and this is at the 30,000-foot level. When you're either beginning operations over there, or frankly, as a reminder, when you're doing business overseas, you want to think about what's to your best advantage and how can you maximize your business activities there. Certainly, getting caught in the switches of currency fluctuations is one that, if you can avoid it, you want to avoid that. So to the extent that you're dealing with service providers or any other contractual relationship that you may have, you want to be on a safer footing and think about having that in U.S. currency. I think that's one, is it always feasible? No, it's not. But to the extent that you have the upper hand, I think that's one that a lot of people forget about. There may also be, depending upon where you're doing business, wherever in the globe, there may be remuneration issues. Are there restrictions as to repatriation of dollars? Are there requirements that you reinvest the money locally, et cetera? So take a very broad view when you're thinking about your international operations. And I think in this sense, one size may not fit all. It may be that in certain areas you're going to find that, let's say in the Middle East, for example, there may be local restrictions that will require you to plug the money back in, or in Asia. Certainly in China, for example, it's difficult to do business there, and other parts of the globe may also find some, similar restrictions. So think about, before you plunge into a country, are you going to be able to extract the money, should that be part of your goal, or are you going to be automatically required to reinvest it? Because that may play into how much, do you fully invest? Do you do just a lighter touch just to explore the market? So those are ones, it's all about the money at the end of the day, isn't it? So at the very start, that's one of the things we want to think about. What we've also seen is additional banking controls and restrictions there. I think in the past, other governments have not been quite as focused on the nonprofit, foundations, charitable organizations, but I think the light bulb has gone off in many foreign governments' minds to say, okay, this is something that we want to regulate, whether it's pressure from domestic local organizations or whether it's, feeding their own coffers, looking as revenue generation on their own behalf. I'll leave it up to you to decide which is their motivation. We have seen greater scrutiny there. So you certainly want to make sure that whatever your expenditures, however you seek to invest, that you've got really tight accounting and record-keeping procedures in place. And that'll obviously entail getting local guidance. And just a bit of warning there, I think with local guidance, you want to do your due diligence. Who's providing you the guidance? Are they reputable? Do they practice in a manner that would be somewhat consistent with U.S. or global standards? And certainly Charles will be discussing more about that. But one of the areas that has been under scrutiny is cash expenditures and cash transactions. So what used to be the old, heavy slush fund in the past was fine, and it's just a bit here and a bit there. That really is a focus of attention. So, it's a fresh start, new year. It may be appropriate to take a look at what your policies and procedures are with regard to kind of the slush funds.
And Lindsay, if I could interrupt for just a second.
Please do.
What we're finding now as nonprofits go overseas, there's a new tax act called FATCA that just became effective July 1st of last year. And as a result, it's becoming increasingly difficult for U.S.-based operations to establish foreign bank accounts. And so whereas in the past it might have taken a day or two or a week or so to work with your local bank here to set up a bank account in Indonesia or in China or in Russia or wherever, now it's becoming increasingly difficult, and the number of banks who are willing to do that and bank U.S. operations is decreasing significantly.
Yeah, and I think that's certainly an important issue. It's it's not only the U.S. operations but global operations. And I know we'll talk about this later, but for example, if you're doing business in India, and I've got later on in the slides the act that's applicable there, what you're finding is that the banking authorities are challenging whether or not U.S. Entities or non-domestic entities, not to target U.S. alone, but non-domestic entities can even have individuals as signatories to accounts or play an active and decision-making role in those financial organizations when they're in country. So you need to be mindful of that. I think this is a new trend where we're starting to see kind of this wave of non-local organizations had rather unfettered flexibility, and that's getting restricted now. So I think when you're dealing with your overseas organizations, be sure to ask, are there any recent laws that have been implemented? I know the Indian Act is one, or are you seeing heightened enforcement? It's difficult to just know that from afar when you're sitting, in your office in the U.S., but your local operations and employees, and certainly your local service providers there, your accountants and the like, should be able to provide you some guidance on that. So one thing that you can do is to look to try and implement a global policy, and I realize that that's easier to say than it is to actually do. What you want to find, though, is a base level that you're comfortable with from a U.S. perspective that you can also implement as a policy. So this is kind of a general policy level. At the procedure point, when you're actually, when the rubber hits the road, you may need to modify it for local requirements. But if as a policy, as an organization, you want to have this level of officer have signatory authority or something along those lines, when you're working then with your local organization, you can say, look, this is our global policy. We're not just targeting this country or that country. This is our global policy, and this is what we seek to implement. Now, again, at the procedural level is where you can, fine-tune it and say, okay, well, for this particular country, they require a local person to have signatory or co-signatory authority. So things along those lines you want to think about, and also then implement it consistently. So it's great having this policy, but if you don't actually roll it out and do a check, okay, so let's audit, let's check. Do you have to audit all of your organizations? Let's say you have 5 international organizations or locations. Do you have to go to all 5 of them every year? No, you can do a rolling basis. But you want to at least have a spot check such that you as an organization can say, look, we've implemented this global policy. We're looking and we're checking and we're training our local folks to make sure that it is actually being implemented. Okay, obviously, one of the hot areas of late has been the FCPA, Foreign Corrupt Practices Act. That goes back to the 70s from the U.S. perspective, and for many, many years, it was one where most other countries would say that's just the U.S. being the U.S. They have that long arm and heavy hand. They're reaching outside of their borders, et cetera, et cetera. Within the last probably 5 to 8 years, however, other countries have caught on. And so the anti-bribery provisions, which impact all U.S. Persons and organizations and operations in the U.S., really have seen the tide turn globally, so that anti-corruption is now a huge focal point. And again, it's follow the money. It's a huge focal point. There was a misconception, I think, for many years that, that doesn't impact non-public companies and it doesn't impact charitable organizations and foundations. And that myth has certainly been debunked. There have been investigations, and frankly, the targets of late have been more on non-U.S. operations than U.S. operations. So it may be your affiliate overseas that gets into trouble with or without your knowledge, but the control and the oversight is usually imputed to the parent organization. So as everyone knows, the anti-bribery provisions prohibit the paying, offering to pay, promising to pay, so you don't actually have to do the deal, or something of money or anything of value. And the anything of value is very broadly defined. With a corrupt intent, directly or indirectly. Okay, we can just pick your pen and cross out the with corrupt intent, because usually that's imputed as well, to a foreign government official or political party official. That piece of the puzzle has been broadly interpreted, and frankly, until the last couple of years, there has been little pushback on that. And if you think about it, most organizations won't want to be prosecuted under the U.S. Foreign Corrupt Practices Act because they can lose their benefit of dealing with the government, right? They kill the golden goose. So no one would want that to happen. So there has been settlement, and so there's been this case law developed by settlement. And what you find is when that happens, these definitions don't really get tested. And it's only been over the last several years where the target has been not only overseas, as I mentioned, but also on individuals, because the government said, we need to go after individuals to really get people's attention. So with that, if you now have this new fear, you're an officer or a director, and you have this fear of wearing stripes or, wearing orange is the new black jumpsuit, you want to challenge these definitions. So we've seen then where there has been some pushback. Now, interestingly enough, from the U.S. court perspective, the government has succeeded in many instances. So foreign government official in the U.S. is generally pretty clear. Overseas, not clear at all. You may find that individuals wear multiple hats. They may be president of a private organization and at the same time wearing another hat on the head as a member of a government agency. So you need to be mindful of that. Yes, sir, we have a question. Just wait a sec for the microphone, please. Thank you.
I'm with United Way Worldwide, and I've dealt with this issue of defining what is a foreign official, very often confusing, specifically with China.
Yes.
Because with China, a majority of the NGOs are gunkos, so they're government, and so on the boards they're completely government officials, and it's been a nightmare for us trying to decipher what is a risk, what is not a risk. I'm not sure if you have any experience of navigating the complexity of China specifically.
Yeah, China is a very difficult. It's obviously an interesting marketplace, but it's also a very challenging marketplace. And I think you've hit the nail on the head in terms of identifying. There are many in Asia. Asia tends to be very blurred, but I think China is kind of Exhibit A, if you will. I think you need to ask the questions. You have to put yourself in a defensible position. Now, if you ask the question, ask for certification back, ask for something in writing back. Are you, do you hold a position in blah, 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 some other government, political party, et cetera. Most of them are political parties, but you also need to assess then, okay, are you just a card-carrying member of the party, or do you play an active role? Do you have a position of authority? If you get something back, then at least you have a defensible position. You're never going to get 100% certainty. It's difficult and challenging. What you then want to do is push back to them and say, as you know, we as a U.S. parent organization are subject to this law, and we expect that you will not request and take action to violate the FCPA. So kind of push the burden back, first get something from them to the extent that you can, so you'll have like a first line of defense, and then secondly, push the burden back to them. I think that would put you in as best stead as you can, after doing your due diligence, as you've noted. Getting information on the ground is helpful, looking to the Commercial Foreign Service in the particular country, find out what you can from them, like just the ground information to double check what you're hearing. We also work with service providers in country to do a double check, trust but verify. We've all heard that saying before. Just to put the organization in the best position so that if an issue gets raised, you can say, look, we did our due diligence, we trained, we monitored, we audited, et cetera. And there was a Morgan Stanley case. Obviously, this is on the public company side. But under FCPA, there was actions that were undertaken in their office in Asia that were found to be bribing local officials. And the U.S. government chose specifically not to go after the parent organization, saying, look, you trained, you did your due diligence, you were affirmative in your obligation of taking reasonable care steps. So I think that's a good example to show where if you do undertake that effort, it can pay off. Is it a perfect defense and perfect package? No, but I think it sets you up in the best position under a reasonable, practical. Yes, we have another question. And I'm only on slide 8. Whoops.
Thank you very much. It's more just a quick follow-up.
Sure.
Given the converging global regulatory frameworks, especially in the UK,
yes.
My sense is now that it's probably a better use of time and resources to take a rather expansive view, even if it might not seem that there are entanglements that would trigger jurisdiction under the UK. Given the fact that they don't make these fine distinctions like we do, whereas the FCPA for many, many years was the leading regime, that's no longer the case on some of these issues. And it would seem just in terms of risk management that a better use of resources often will be to look at what the broadest application might be, because even if they're not dispositive, they really do start to become the real standards for the behavior, aside from the ethical question. In terms of the way, in the reputational issues that companies face, like Johnson & Johnson and others, where they go for decades with a great reputation, and then it only takes one or two of these incidents to really screw it up. So I see near the end of your presentation you're going to be talking about some of these other issues.
Right.
But I think really looking at the converging global regulatory framework, those become the de facto standards.
Yes. Completely agree. The U.S., as I said, historically we had been the high water mark and had been really the lone ranger out there, the U.S. government. That has completely changed now. And frankly, what's interesting is you don't hear about the local laws that are being pursued. And ironically, China has one of the most rigorous enforcement actions for anti-bribery. Now, most people, if you'd ask them, really? So you're going to see that trend, and I think the point, too, about the UK Bribery Act, that's interesting because it doesn't focus on foreign government officials. It's more broadly defined as just business, dealing with business. There's not that particular restriction, definitional restriction for foreign government officials. And I do think you need to look at your compliance, and this is a good segue to the next. You need to think about your compliance globally. Okay, so I'm putting up that heat map, and this is from Transparency International. Many of you may be aware of it. So take a look at this and think about where you're doing business. So the darker the color red here in this instance, the higher the likelihood of corruption. And this has been assessed by Transparency International on a yearly basis. And so if I flip then to the next chart, you'll see, it might be difficult to read on the screen, but you can see there that if you're dealing with New Zealand, Denmark, you're probably pretty good. So to the gentleman's last point, you want to, you can't conquer everything in a day, so you want to think about it from a priority standpoint and prioritize where you put your efforts and your time. Now, if you think, the U.S. and the FCPA, you'd think that the U.S. would be right there up on top. Frankly, the U.S. is listed lately at 24. Many would say that's because of New Jersey. Apologies for anyone from New Jersey. But there are a lot of other countries where it's very popular to pursue activities for associations. So, for example, China is over there at 75. We've got, I can't read that, India is at 85? I have to look over here. 95, thank you. My kids keep saying I need reading glasses. It's probably true. So anyway, take a look at that and think about it. So when you're looking at your global operations, would you start your review activities in Denmark? Probably not. You'd probably move that down lower on the list. Some of these other ones, Mexico maybe, think about where you're doing business and think back to that heat map because that'll provide you with some good guidance. The one thing we want to do, as we discussed before, is do some due diligence. And don't focus that so narrowly only on your operations, but think more broadly. Are there people and organizations operating on your behalf where their activities can be imputed to your now responsibility? So you want to think about the service providers, any agents, representatives, and the like. Think about not only your employees, but also your joint venture partners, and you certainly want to make sure that you vetted them carefully.
Lindsay, on that point, we have a question from the webinar. Someone's asking, with respect to vendors and supply chain providers and others with whom you're contracting overseas, what are some kind of best practices or tips for the U.S.-based organization to take to try to help ensure compliance on their end?
Great question. I think you want to do the same thing that we discussed before. You want to put your organization in the best defensible position. So what does that mean? You don't want to presume that they've heard about this FCPA. You don't want to presume that they know what their obligations are, because then, you're not doing yourself any favor. What you want to do is, again, push it out. If you say, here are these restrictions. I'm sure you've heard about, here are the restrictions. Do it in writing. Push it out to them. Ideally, if you can get them to certify coming back to you that any activity that they undertake on your behalf, forget what they do for every other organization out there, but what they do on your behalf will be compliant with these laws and restrictions. That's ideal. Now, some would say, oh my gosh, we got 100 service providers in 80 different countries. This is just a paper task. It's impossible. Then I'd say, okay, again, it's a level of risk and a matter of assessing what your comfort level is with that risk. Then perhaps you just want to push it out. You want to just say, we're a U.S. organization. We're subject to this law. You're an extension of us by operating here in whatever capacity. So maybe you want to push out that obligation and have a record that you have shown them that, have trained them on that through a webinar or some other activity. So I think that would be kind of the secondary position. Certainly the first one is if you've gotten an affirmative certification from them saying, and I think back in the day when we used to talk about this 10 years ago, getting them to certify, they're like, no, I'm not certifying anything about any, crazy U.S. law. What do I care about that? Now they're starting to understand it a bit more, and I think part of that is this trend in globalization, right? Okay, the future is plastics. I feel like I'm talking like that. But the trend in globalization is specifically with regard to anti-corruption. What you find is other governments have said, we're looking at the U.S. Department of Justice, we're seeing these settlements with a lot of zeros after them. We have these laws on the books, certainly after the OECD, 38 countries put in their own anti-corruption laws, and many others that are not part of OECD, Brazil, China, et cetera, have also implemented their own national laws. And so they see this as a way to not only ensure to their public and their businesses that they're doing what they can, to make sure that corruption isn't running rampant in any domestic operation, but they're also really working on a global plane. Like we're saying, okay, we too, country A is also a global player, and so we too respect these restrictions against graft.
And Lindsay, you have on the slide, consider your employees, as you know very well, because you and I and others have done this together. We frequently go around to clients of ours that have large workforces, large numbers of employees who are engaging in activities overseas to do this sort of training for them. So it's not just those of you who are here in the room or on the webinar. In fact, a number of the clients we've done that for are participating in today's program. But when you have a large number of employees or even just program folks working in different areas but have a lot of responsibilities, oversight, contact overseas, they need to be trained in this area as well. And so that's very, very important for you, the folks participating today, to make sure this information gets passed out to the rest of your related workforce.
Yeah, and I think Jeff raises a good point. When you think about this and the education that comes behind it, it's really stratified, if you will. So the president of an organization may have an understanding as to, at a policy level, we as an organization shall not promote, permit, any sort of graft. When you then trickle down to the program level, okay, that person has a different, they're interfacing with the local governments or the local businesses or the local, entity base. So they've got a different struggle. And then again, if you're talking about the folks in your accounting department who are actually reviewing the funds, reviewing the requests, does that happen centrally? Is it dispersed, and is that happening, at the various country programs? So you have to think about that. And the education, while the message is the same, the examples and the procedures and the implementation can be different. So think about that. And as Jeff noted, we provide guidance on that because it can be tricky. And often the best forms of education are the discussion points. And I usually say, if somebody raises their hand and said, well, I was in this position once when somebody was asking me, I'm like, okay, let's start again. I have a friend who was in a position once who was approached. But just having that dialogue and going through the examples is frankly the best way to kind of tease things out. Is it an area where it's so clearly demarked from this line is okay and that line is not okay? No, it's not. But you also can, again, approach things with what's your comfort level from a risk perspective. Is the country more likely to be higher in risk? Is your activity going to be something that's more pervasive and more, it's not a one-off issue, but could be assessed as an ongoing repetitive problem? Those are all factors that obviously the government would, whether it's our government or any other government, would consider. Okay, so do think about all the parties with whom you interact. Usually you start with your own folks and then expand beyond that. Again, from a practical standpoint, it's difficult to accomplish everything in a day. But consideration for your employees, these are some of the ones that we have discussed in the past. So is the target country prone to corruption? That's a good starting point right there. What's the reputation of the representative or the agent that's working on your behalf, or the joint venture partner? Are you going in looking to join with an already established organization in that country? What's their reputation? Have you done some digging on that? Not only from what they tell you, but the on the ground information regarding the organization. Are the demands for fees or commissions, are they excessive? Are they representative? All of that. Give it the old gut check. Does it feel right in the gut? If it doesn't, certainly dig further. And then, you have to look at whether or not your representative has, is the reason that they're so good at what they do because they've got such great and tight and long-standing relationships with certain government officials? If that's the case, it may be fine, but the flag should definitely be up the flagpole, that red flag, because you want to pursue that. Are they qualified in their own right to do? Now, all of these, if you think about, these are all just action items, but it's, again, like I said before, it's all about the money. So what is being paid? How are you compensating these either entities, organizations, individuals, and the like? So that's what you want. Those are some of the considerations that you want to think about. Okay, some due diligence. We talked briefly about this. So third-party due diligence, get somebody on the ground, local, independent, have them kick the tires and figure it out. Do your own interviews before you plunge in. Make sure that you eyeball the place, eyeball the folks. Make sure that you feel comfortable with them. You can get an opinion from counsel or other sources. We talked about that before. The U.S. consulate or the U.S. embassy, the commercial service offices in many of the countries are a great resource. They're there, constantly, even though the personnel may churn every 2 or 3 years. They have a good sense as to the reputation and should not be overlooked. And like we mentioned before at our outset, think about your agreements. Have you put yourself in the best defensible position? Create your own best line of defense. So think about it. It's January, it's a new year, it's kind of the natural time to say, what are our policies in terms of the money flow, who we're allowing to do what, and then, educate and do training and then auditing. So that's enough on that side tangent. But I think we talked about this. Now the reason you want to do all that is because you don't want to get hit with it. You don't want to have your organization's name in the papers. That's almost worse than the fine, frankly, because just the reputational risk can be tremendous. You also can acquire a problem, which is why you want to do your due diligence before you expand by acquiring a local organization. You want to make sure that you're comfortable with what they've done, with whom are they dealing. You can acquire a problem through successor liability. The statute of limitations on all this is 5 years. The government's happy to go after that. Think about where you're doing business, as we mentioned before, and then again, the new standard is kind of this global standard. It's local. You may be subject to local laws, local anti-corruption laws, in addition to the U.S. laws and any others where you may be doing business. Like the UK Bribery Act is an interesting one because it essentially, to have the jurisdictional hook on that is essentially having, a person there with a desk and a phone in the UK, like full stop. The activity can occur. You can have bribery occurring in Tanzania with money flowing to Brazil, but if you've got the person that's, desk and a phone in the UK, jurisdiction will attach there. Very broadly defined. I think historically everyone had always said that the U.S. took that long arm and heavy hand reach, but so this is kind of the new norm that we're living with, and so think about that. The other important point is joint enforcement is the new trend. What we find there is that the U.S. government has been very aggressive in pursuing these investigations. The U.S. laws also permit vast discovery. And so what you find is a lot of countries will play the Me Too game. They'll say, okay, the U.S. government has opened an investigation and the activity, the alleged bribery occurred, let's say, in Germany, and the German government will say, okay, well, we want to pursue that investigation as well. No, we'll just take a back seat. You go ahead and finish off your case, gathering all this information that the German authorities couldn't otherwise gather, and then they say, thanks very much, package it up and send it over to us. And that's much more common these days than it was, even 5 years ago. So joint investigations and kind of this Me Too phenomenon, because they too want to, add on to their coffers, I think, when they see activity that was prohibited under their particular laws. Okay. So any other questions on the FCPA? Then let's just switch gears here. And I'm just this could be a whole day long, fascinating discussion on U.S. export controls and those laws. But I'm going to give you the 30,000-foot 101 lesson on that instead, because I think it's important to understand. Most people go, okay, I'm sitting in this room, I work for a nonprofit, a foundation, a charitable organization. I'm not a private company or a public company that makes things that go bang. I'm not supporting the defense industry, so why are we even having this discussion? Well, the reason is there are implications that you may not be aware of. It's obviously not with regard to your bread and butter services, if you're in the educational field or the humanitarian field or whatever, but what you find is the accessories and the tools that you and your colleagues need to perform those services can fall within the scope of the U.S. export controls. And we've had several examples where humanitarian organizations, for example, would send folks out to the field. They're working in a very dynamic and dangerous location, and so they need to bring with them satellite phones and other heavy equipment where they can be tracked and monitored, and they can have the reach back should an issue arise or should they need to get evacuated promptly. As it turns out, those tools oftentimes are within the scope of the U.S. export controls. So you need to be aware of that, and it's not just the actual export. If you think about, most people think, okay, Lockheed Martin, I'm sure, has phenomenal services where they've got export control and compliance, and they have a whole team, shipping the stuff out. So that's not me. Well, an export can occur by hitting the send button on your computer. An export can occur by putting something in your suitcase as you head out to Dulles to travel overseas. An export of technology can occur by inviting someone, a non-U.S. person, into your conference room and having a discussion over controlled technology. So it's more than just kind of the normal definition or concept of sending something out. So for that, U.S. export controls, they govern U.S. origin goods or things in the United States that are leaving the United States. So even if you had a French-made satellite phone and you brought it here, you wanted to test it out, make sure it was, going to work well for your needs, and then you give it to your person, your program manager, who's now headed out to Syria, you have to check and say, do you need to get a license for that because it's controlled by the Department of Commerce, or is there a license exception that can apply? Are your computers such that they have such a high capacity? Now, computers lately, it had been the encryption that had been problematic and still controlled by the Department of Commerce. Lately, all you have to do is ask, your kids, and they've got these unbelievable computers that are in their phones and everything else. So it's a different day than it was 10 years ago, but nonetheless, there are still restrictions that can apply for encrypted matters. And oftentimes, most laptops, iPads, et cetera, have some form of encryption on them. So you just want to make sure that you're not using one that falls within this requirement for regulatory controls. Okay, so we're going to move to the sanctions side, and I think there it's the Department of Treasury that governs that, and this is what we commonly hear about in the newspaper. So the sanctions are what govern the transaction. So it's not the actual export of anything, but it's the transaction. So it's the dealing in, consummating a deal, pursuing activities, and this is where there are targeted sanctions. There are more global sanctions and embargoes. So if you think about it with Iran, it's a more global sanction and embargo where we're prohibited from dealing directly or indirectly with Iran. In other instances, it's more narrowly defined. So when you think back to your heat map and where you're doing business, you also want to give some consideration as to whether or not there are any of these sanctions programs. So let's take a look at this. The Department of Treasury, OFAC, is the entity that governs that, and you really have to assess, as U.S. entities, you're subject to it. As U.S. persons, you're subject to it, whether you're here, there, anywhere. It follows you. The activities are not static. Oftentimes they're financial in nature, so you can't do business with certain individuals, certain organizations, certain entities. You can't undertake certain activities that are prohibited. I'm thinking of, like the diamonds, the diamond trade that's restricted. Most of them, though, are transactional. It's a listing of persons that you can't do business with, or if you do, it's a violation. Now, fortunately, the government has consolidated that list, so there's one list to check now. Before, there used to be like 8 different lists. So you want to make sure that when you're starting an operation with a new organization or a new person as your service provider overseas, check the list. It's simple as that. Check the list and make sure that they're not on the list, and then periodically recheck the list because it is dynamic, and you find names come on, names go off. That's one where I'm the nerd that reads the Federal Register every day just to see what the changes are, because you do see updates on that regularly. So the most recent one is this the Ukraine-related sanctions, the Russian sanctions everyone's heard about, and I'm going to give kind of a high-level overview. This is one, it shows a shift in what we're seeing from sanctions, and I think it's one where you should be aware of it because we're going to see more of this. So as you can see there, the executive order, the president had the authority in March to implement these orders as a result of what happened in Ukraine, right? And so you can see they're authorized under these various statute and regulations, and that's all well and good, but really the meat of it came down to this directive, a presidential directive, Directives 1 through 4. They focus on the energy industry as well as the financial industry, but it's not so tightly defined as to only be that. So Directive 1, financial services, and have restrictions of new debt 30 days and more, new debt and equity of 30 days and more. So that's one where if you have dealings with the sectoral sanctions identifications, or these SSI, people, individuals, organizations, and entities, you need to, number one, check more closely to see if, in fact, you're having current dealings with them. This is a new phenomenon where the government said, we're not going to do a full restriction, but we're going to identify certain people and certain organizations that we find troubling. They tend to be in these various sectors, whether it's financial services and energy or defense. But we're listing these organizations in Russia. And if you're doing business with them, you need to go then the next step and read the fine print and figure out whether or not your activity is prohibited or not. It's not a blocking statute, and those of you who are familiar with the Treasury sanctions know that a blocking statute means a full-out cannot do business. So in Cuba, blocking statutes are common. You full out can't do business. A couple of years ago, the U.S. government started to relax that to say, okay, humanitarian issues, food and relief along those lines, some support services, those are all now being permitted. But this is the first time where the president came out and said, look, these are sectoral sanctions identifying certain people. There have been new people added to it. There have been some that, I don't know if any have fallen off it yet, but there have been some definitional issues that have come forward. So I think this is the new trend. There are 2 general licenses, but frankly, that's really more cleanup than anything. It was sort of a transitional. The government said, okay, we realize that you may have been doing business with these organizations when these sanctions went into place. So we'll give you, some leeway to unwind your business dealings. The most interesting part, frankly, is what you find here on guidance that was issued in August. So the directives were put out in March, amended, and then the last amendment occurred in September. So the month prior, Treasury Department came out and said, look, we're putting out this guidance to our sanctions programs to note that the sanctions are interpreted to include entities owned 50% or more in the aggregate by more than one blocked person. Okay, so that's interesting because we talked about that these aren't blocking sanctions, but you want to understand, are you doing business with a person that's on that SSI list? Okay, that's a clear no-no. Or does that person on that SSI list have an interest or a 50% or more controlling or ownership interest in the organization with whom you're doing business? That's that gray zone, and that's where, when the rubber meets the road, that's very difficult to assess, but that's our new reality today. So going back to what we talked about under the FCPA, the same would apply here. You need to dig further. You need to, peel back the layers of the onion and ask, when you're working with an organization, get the certification back from them that none of their controlling owners, operators, or other interests are on this SSI list. It's a way that you can try to protect yourself. Everyone is sort of feeling their way through, including the Treasury Department. There's this OFAC working group that regularly discusses on a cooperative basis with the Treasury Department officials to say, look, we understand these as a policy matter. We're trying to work through them as a practical matter, so help us here. But this new owned 50% or more, is very challenging as a, from an organizational perspective. And then most recently, just before the holidays, for the holiday gift, the President signed off on this Ukraine Freedom Support Act of 2014, which also gives additional discretion on imposing sanctions to the government, to the President. So, you're seeing this as a new trend. If you think back, what happened in the past, it was, the Iran full block, that was easy, can't do, full stop, Now it's you really have to understand very intricately with whom you're doing business, what's their level of ownership, who owns them, to make sure that those individuals and organizations are not on these particular restricted lists. Okay, so what can we do? Do some due diligence, watch out for significant ownership of less than it, certainly ask more questions there, figure out what controls mean. If you do have somebody, like let's say that you're dealing with company A as a service provider, ask who are their 50% more owners, like are any of them on the list, like ask the questions, and I realize that it's burdensome. We talk about all these regulatory provisions, but you certainly don't want to fall into this. These are strict liability laws, so just the mere act of undertaking the transaction with them means there's a violation. So again, going back to what do you want to do? One, do your due diligence beforehand. Number two, put yourself in the best defensible position. And number three, continue to ask and re-ask the questions. And there are also some restrictions that the Commerce Department has implemented, kind of concurrent with these Treasury restrictions regarding Russia. So if you've got business interactions with Russia, really take a close look. Now, I'd say also, Cuba, many on the humanitarian space have been doing a lot of business in Cuba. I'd say keep your eye on that because it might, a new day may be dawning there. So that's another area to consider. And then also think about, we can't be just U.S.-centric. Think about other sanctions and other provisions. So if you've got operations in the EU and other countries, the EU implemented very similar, not identical, but very similar sanctions programs. So it's not just U.S.-centric. So you want to see these pretty much track the same U.S. programs and restrictions that we're facing here today. And then what you also see is those have been extended. Australia, they've extended theirs overseas, territories, Bermuda. You don't see, however, in those other country restrictions this 50% ownership or 50% control issue. So that's unique to the U.S. Some other EU member states declined to impose the sanctions, Finland and Slovakia by way of example. So again, if you read the news and you follow and track kind of political global events, you'll be more attuned to it. But it goes back to that very early first question and first discussion point of where are you doing business? And then from that starting point, prioritize and reprioritize where you can put your efforts for your compliance activities. So with that, I'm going to turn it over to Charles, and he's going to discuss the taxation of foreign operations.
Thank you. As a segue into the taxation of foreign operations, what I would suggest is that many of the people in Russia who own Russian operations don't own them directly. They will go through Cyprus, through Malta, because they've taken money and they've moved it offshore so that the Russian government doesn't know that they're investing in there. So rather than you trying to work through an org chart to figure out whether these people are 50% owners of the entities you might be doing business in, let them certify to you that they're not one of those people, because you'll see bearer shares, you'll see nominee directors, you will never figure out whether or not there is a 50% related interest just by looking at this typical org chart. Okay. We're going to talk about a couple of things on the tax side. One is taxation of international operations. One is if one form is good, two forms is better. The IRS love to know what's going on overseas, and so even though you're a nonprofit, you still are subject to extensive international information reporting. We'll talk a little bit about transfer pricing, and we'll talk a little bit about accounting standards and the differences between GAAP and GAS and IFRS. So the first issue when you have foreign operations is, what are you overseas? Are you a locally incorporated entity established under the laws of China or Russia? Are you a WFOE? Are you something else? Or are you a branch where just like you may have an office in Washington, D.C., and you may have an office in L.A., and you qualify to do business in California, you may have an office in China, and in theory you've qualified to do business in China under the appropriate regulations. So if you are a foreign corporation that's owned by the U.S. nonprofit entity, then it's a separate legal entity. It's going to have to be registered and comply with the appropriate local governmental regulations as to officers, directors, registering the shareholders. Typically, it would have a separate set of directors and officers. There may be some people on the directors at the local subsidiary level who are also directors at the parent company level, but maybe not. Depends upon how many foreign subsidiaries you have, and the people who are on the board at the U.S. May have other things to do rather than dealing with the specific activities in Australia or Israel or wherever. If you're a foreign branch, then you are not a separate legal entity. You are just qualified to do business, and it can be tricky because sometimes where you are a U.S. nonprofit, it can be difficult to actually get the local jurisdiction to qualify you to do business. They may prefer that you just be there, and that way if they decide they don't like what you're doing, they can say stop doing it. Whereas if they've qualified you to do business, they've taken a position that says, yes, you can do this business activity in this country, and that may have limitations on what they can do down the road in terms of withdrawing it. There are some practical issues with not registering, which is the fact that you may be tax exempt in the U.S. is irrelevant from a local country perspective. They have their own rules, their own regulations as to whether or not you are going to satisfy their version of 501c3 or other 501 tax-exempt entities. And so we've seen situations where the nonprofit in the U.S. tries to do activities in the foreign jurisdiction that they view as commercial rather than being as nonprofit. Particularly if all you're doing is putting on seminars and conferences that people are paying for. There may be, we'll get into it, there may be sales tax issues, there may be VAT issues, and so forth. So you need to coordinate with local counsel and local advisors as to whether or not you're even going to be viewed as a nonprofit entity for local purposes. From a U.S. perspective, if you are a you're using a foreign branch as your method of operation, as long as the activities that the foreign branch is doing is consistent with what the U.S. is doing, then for U.S. purposes, the fact that you're doing them overseas doesn't cause that to lose its tax-exempt character. But the UBTI rules still apply, and all of the international information reporting that we'll get into later applies. So the fact that you file a 990 and you say I'm tax-exempt doesn't get you out of all of the other reporting, and more importantly, the penalties that go with not filing all the information returns we'll talk about. Now, typically, and we'll get into a little more detail, if you are operating overseas through a foreign entity, then there's this form 5471 that you need to file for each entity where you have more than 10%. Typically, If it's wholly owned, or typically it would be a wholly owned foreign entity, and you have to provide extensive information on the 5471. Foreign branches, there is no separate reporting, just like the operations in LA would be included in the financials of the parent company in DC, the same with the branch office in the UK, and it would just be consolidated with the US activities and included on the return. As we said, qualification as a nonprofit here doesn't govern qualification as a nonprofit elsewhere. You really need to consider the VAT or the GST, the goods and sales taxes, because we've seen a number of situations where a U.S. nonprofit will hold a conference in Istanbul, and they do it every year. Well, now you're buying local goods and services for use in Turkey. They want to collect the VAT tax, because unlike the sales tax in the U.S., which is imposed on the ultimate end user, the VAT is imposed on every single step in the chain. So the fact that you may be an intermediary putting on the conference doesn't mean you get out of having to pay the VAT. So the way the VAT works is you, as the conference host, would pay VAT to the hotel, to the trade show exhibit, for the rent on the office space or the rent on the conference facilities and so forth. And then you have to account for that. If you haven't charged the attendees VAT, that becomes an additional cost to you, and that VAT can be up to 20%. So your budget, if you didn't budget paying the VAT and you don't collect it, you've now got a 20% shortfall, and it's unclear where that comes from. So always talk to your local advisors about VAT and GST, because they can have some different consequences. Double taxation agreements. The U.S. has entered into what we call DTAs with a number of primarily developed countries. And the idea was, in most cases, if the U.S. pays money to a foreign entity, there's a 30% withholding tax. The foreign entity isn't subject to U.S. income tax, but they're getting money from the U.S., and the U.S. says, we want our share of revenue, so there's a 30% withholding tax. So starting many years ago, all the developed countries in the world got together and adopted these double taxation agreements to reduce withholding taxes and to also deal with what they call business profits, and to provide that if you have business profits, they're taxable only if you have, quote, a permanent establishment. There are very few DTAs that specifically deal with charitable organizations. And the two that came to mind as I flipped through a number of the treaties were Canada and Germany. And that means all of the other countries that we have treaties with, the treaty doesn't deal with if you're a U.S. charitable organization, do you qualify locally? And there are countries that are third world countries, Latin American countries, the Caribbean, and anything that looks like a tax haven, we have an exchange of information agreement with, but we don't have a tax treaty. So Brazil, we don't have a tax treaty with. Russia, India, and China, we have treaties with, but they're silent as to charitable organizations. So there's no help. The fact that we've got a DTA that may reduce withholding taxes, for example, if you have a subsidiary in Russia and you've licensed your trademarks and intellectual property and you actually charge them for that, the DTA with Russia would reduce the withholding tax that they have to pay. So even though you're a nonprofit in the U.S., if your Russian subsidiary or your Indian subsidiary is paying service fees, or you've lent them money to finance something and they're paying you interest, or you've accumulated funds and you bring the funds back here, those could be subject to withholding tax, which you have no tax liability in the U.S. against which to offset that withholding tax, so it becomes an out-of-pocket cost to you. Okay, international information reporting. it's
And wait, one
perfectly-
question, Charles, before we move on. Was there a question back here?
Sorry.
No, okay.
Okay. So it's perfectly appropriate for U.S. nonprofits to have as many international operations as you care to have. And you can have them from a tax perspective, from a tax perspective, you can have them anywhere you want. OFAC and Sanctions may say, no, you can't have them in particular countries, but from a tax perspective, you can do whatever you want. You just have to report it. And the information reporting requirements, as I sort of said tongue-in-cheek, if one form is good, two forms is better, applies in the international area. And they apply to nonprofits just as much as they do to for-profits. And they can apply to nonprofits in one of two ways. They can apply operationally because you've established a subsidiary company in Russia, and now you have to file information returns. Or you could be a university or a foundation that has a large endowment that you're investing, and to deal with some UBIT rules, you may invest in a foreign hedge fund that invests in the U.S. markets. Now, through your investments in the hedge funds, you are subject to all sorts of information reporting. And they are very focused, the IRS and the DOJ are very focused on this area. If you've been reading in the newspapers, you may have seen that Credit Suisse wrote a $2.8 billion check to the Treasury Department middle of last year for their activities in helping U.S. people set up unreported foreign bank accounts. UBS wrote a $750 million check back in 2009. There's a very, very aggressive enforcement action. Some 135 Swiss banks have entered into an amnesty program with the Department of Justice and the IRS for their role in offshore tax evasion. So it's an area, even though you're a nonprofit, they're very focused on. Let's talk about FinCEN, what is now Form 114. It used to be the 9D-22.1. So if you have a financial interest in or signature authority over a foreign financial account, and when you add up the money in all of the accounts, not just each account, but all of the accounts, that adds up to more than $10,000, then you have to file this form. If you have more than 25 accounts, then you fill out your name, rank, serial number, and so forth, and check the box that says, I have the information and will provide it. But if you have less than 25 accounts, you have to file information with respect to each of the foreign financial accounts. They want the name of the institution, the address, the account number, the high balance during the year, whether it was joint owned, whether you just had signature authority, whether you had a financial interest. And the term persons includes nonprofit entities. This is not a tax form, so it has a June 30 due date. It's not tied into when you file your 990, and it has to be filed electronically. That came into effect as of July 1st of last year. So there's no more paper filing of the forms. It has to be done electronically. You are considered to have a financial interest if the U.S. person owns more than 50% of the foreign entity. So if you're a U.S. nonprofit and you have 100% ownership of a company in India and it has a foreign bank account, even though nobody in the U.S. has signature authority on that account, you have to report that because you are deemed to have a financial interest. And foreign financial interests are very broadly defined: bank accounts, brokerage accounts, mutual funds, private equity funds, hedge funds, certain insurance contracts. And you say to yourself, okay, so I have to file this form and I haven't, so what? Well, the so what is, there is a 6-year statute of limitations, not the standard 3-year tax rule, so they can go back for 6 years for each account, and if you can convince them that you're non-willful, they will assess a $10,000 per account per year penalty. So if you have 3 accounts, that's $30,000 a year times 6 years, that's $180,000. It adds up very quickly. And that's if you can convince them that you were non-willful. If you were willful, then the penalty is 50% of the high balance in the account. So this is an account in India. You have no signature authority over it, but it's got a $200,000 balance. All of a sudden, you're potentially looking at a $600,000 penalty if they decide you were willful. Where the money comes to pay the penalty is a different issue. But this is why you care.
Charles, before we move on, 2 questions. First, in your first bullet point here, consider to have a financial interest if the U.S. person, including nonprofits, owns more than 50% of the equity or other interest in a foreign entity. If that foreign entity is organized as a nonprofit or the nonprofit equivalent in that foreign country, and so there's no ownership, but there is control, say the ability to appoint 100% or 75% of the board members of that entity, or again, the governance equivalent, would that also trigger this requirement?
The answer is it's unclear. There is some guidance out there that has not been finalized that says if you have a non-stock corporation where you get to appoint the board, then you might be considered to be an owner of that entity, in which case you would have to file the 114. As a practical matter, there's no upside to not filing the form. Millions and millions and millions of these forms get filed, and in 35 years of practicing, I've had 2 questions on the forms that got filed. Both were in the old days when the IRS said, it's illegible, we can't read it, please send in a clean copy. So over 35 years, I've never had a question asked specifically as a result of filing the form. The downside, as we talked about from a penalty perspective, it can be quite significant. So our advice is always, when in doubt, file, because you're not losing anything and you're potentially protecting yourself.
Okay, another question. Does any of the information that gets reported on this form have to be reported by cross-referencing on the Form 990, or are they completely separate?
I believe, and it's been a while since I've looked at the 990, on the 1040 form, there's a box that asks whether you have on Schedule B, which is your interest and dividend form, there's a box that asks. I believe there is a question on the 990 that asks, do you have an interest in a foreign financial account? If you do and you say no when you should have said yes, case law says that is a willful violation of the reporting statute, subjecting you to the 50% penalty, not the $10,000 penalty, because you are, as the person signing the return, are meant to know what's in your return. You are considered to have read through it. You saw the question, you said no, and that's willful. Sorry, go ahead.
My question is with respect to loosely held chapters overseas, where these are volunteers who run their own operation, have their own accounts, and it is not a requirement for them to report their financial dealings. What is the guidance with respect to that?
Well, wait, Charles, before you answer that, just to clarify your question. So this chapter, it's obviously affiliated with your organization through some sort of affiliation agreement, but what sort of control do you exercise over them other than, say, providing them with a license to use your trademarks?
At the moment, not much control.
Okay, so the test is, do you have signature authority? And the answer is probably no. But signature authority can come one of 2 ways. You actually are a signer on the account, or in the view of the IRS who administer this, you can tell somebody to move money. So if you, sitting here in the U.S., could pick up the phone, call someone in Australia and say, transfer $100,000 back to the U.S., and they would do that, then the IRS would likely take the position that you had signature authority, even though your name is not anywhere on any official bank document. And the same with financial interest. If you can cause money to move, you probably have financial interest, and therefore you should be reporting. If the monies are used locally and they never come back to the U.S., and if you picked up the phone, they'd say, thank you very much, but no, we prefer not to, which is the standard response, at least the one that I've seen, then you probably don't have a financial or signatory interest, and therefore you wouldn't have to file. I think there was another question back there.
Related to this, does that apply to, like, if you invest in any mutual funds or they have foreign investments or whatever, and you don't really know what they're putting in or anything? Does this have anything to do with that?
If you invest into a U.S. mutual fund that happens to have stock in foreign entities, that doesn't apply to you. But if you as a nonprofit invest in a Cayman Island hedge fund, which invests in whatever it does, then now you've invested in a foreign entity, and that investment will subject you both to Form 114. Well, yes, you'd have Form 114 reporting, and then you're likely to get all sorts of questions from the hedge fund under FATCA to be able to show that you really are the beneficial owner and all the rest of it. Okay. So, as I said, there's a lot of forms. If you set up a wholly owned foreign entity, you need to file Form 926 to report the formation of the company, the transfer of assets, and a bunch of other information. That's filed just for the year that you incorporate the company or make a transfer. Once you've incorporated it, if you make an additional capital contribution but you don't take back any stock, you don't have to file another 926. The 5471, however, is an annual information return. There's 5 categories of filers. If you own 100% of it, you're going to file every form and every schedule to the form that there is. It's going to want an income statement, a balance sheet, statement of earnings. It's going to want a schedule of transactions between that foreign entity and the U.S. nonprofit. And these forms are tax forms filed with the 990.
Charles, again, similar to my last question on this point, if the foreign entity is a non-stock corporation, like nonprofits here, does that same control test apply, having the ability to appoint 10 or more % of the board of directors of that entity?
Well, the guidance is unclear. There is some draft guidance that would say if you can appoint the board, then you should treat it as if you owned it. But the last time I checked, that guidance had not been finalized. So my understanding is, as a practical matter, if it's a non-stock company that just has members, you can appoint some of the board. People take the position that that's not subject to the Form 5471 reporting requirements. There is an 8938 form which is applicable at the moment to individuals. So if you have signature authority over a foreign bank account, in addition to filing the 114, you have to file the 8938 and fill out the appropriate sections. That form became applicable starting with the 2011 tax year. Note that the types of assets that get reported on the 8938 is a much broader range of assets than are reported on the Form 114. Okay. If you happen to have a large endowment and you invest in foreign hedge funds, then you should be filing a Form 8865. And if you own stock in foreign corporations directly, they may be what's known as a passive foreign investment company, a PFIC, and subject to a different set of reporting requirements. Okay, let's talk briefly about transfer pricing issues. Section 482 of the Internal Revenue Code says that U.S. entities must deal at arm's length with their foreign entities. Similar laws are applicable in almost every foreign jurisdiction. The OECD has a different set of transfer pricing rules than the BRIC countries tend to use, and so you end up in situations where there's a fight over what the appropriate transfer price is, and the Indian government in particular takes a very broad view of what is subject to transfer pricing. Services, financing, transactions, licenses are all of intellectual property are all subject to transfer pricing. As a nonprofit, the U.S. as the recipient in most cases of these fees is less concerned about transfer pricing because you're not, even if they make an adjustment and the IRS were to say that you undercharge your foreign affiliate, you pick up income, it's not subject to U.S. tax anyhow, so in most cases it's not an issue. But for local country purposes, it may be much more scrutinized because now they may be giving a deduction that they don't want to give. And remember, as we talked about earlier, if it's a license of intellectual property and you're actually paying a trademark fee, there may be a withholding tax on that. If there is a DTA between the U.S. and the foreign country where the transfer pricing issues arise, the fight goes to what's known as competent authority. So there's a group within the large business and international division that deals with transfer pricing. There will be a group within the local countries, tax authorities deal with transfer pricing. They end up in a locked room and they duke it out until somebody wins and somebody gives in and they agree as to a number. If there is no DTA, then there is a potential that you have a mismatch between what you think you should be charged, what the local government's going to give you a deduction for, and they may require you to actually repay it. Okay. Finally, accounting issues. I'm sure everybody's favorite topic. In the U.S., there are two main governing rules. GAAP, Generally Accepted Accounting Principles, and GAAS, Generally Accepted Auditing Standards, and there are special rules for nonprofits and governmental agencies. And the rest of the world says, yeah, that's great, but we don't care. We like IFRS, International Financial Report Standards. So there are significant differences between GAAP and IFRS. So if you do have foreign entities that you own, they will generally have to provide statutory reports to their local country, company's house. Those are probably IFRS, not GAAP. I took a look at the PwC guide to GAAP IFRS differences. It's 215 pages, and I'm sure that's a condensed version. So there are differences with respect to income statements, income recognition, timing of expenses, statements of cash flows, and many other areas. My understanding is that the IFRS rules for nonprofits is not nearly as well developed yet as the GAAP rules for nonprofits. It's important to note that many countries, A, require some form of audited financial statement, and B, may require that you appoint what's known as a statutory auditor. Now, if you're audited by one of the big four firms or BDO or Grant Thornton or whomever in the U.S., they cannot be your statutory auditor in Japan, for example. There are separate groups of people who are statutory auditors. So if you have a local company, you may have to have both a local statutory auditor who looks over your financials and will ask questions about this expense and that expense and your presentation of your financials, as well as having your big four or other accounting firm look over so that you can incorporate all the results in your consolidated U.S. nonprofit statements. Okay. Are there any questions that we haven't covered yet?
Anyone have any questions for Charles or Lindsay on anything we've covered today or failed to cover? Well, hearing none, a couple things. First off, In the email you get tomorrow with a link to today's recording, Marion, we're also going to include links to 2 prior webinars that we did on international related issues for nonprofits that we've done over the last few years that are still very timely and relevant. They may be of use to you and your colleagues. Thanks to Charles and to Lindsay for a terrific presentation. Thanks to all of you for joining, and we hope to see you back here next month. Thanks.